Welcome. Today we're diving into the world of investing by comparing two popular options, mutual funds and ETFs. Whether you're new to investing or looking to refine your portfolio, understanding the differences between these two can help you make smarter financial decisions. We'll break down what each is, how they work, and which might be better suited for your goals. Let's start by defining what mutual funds and ETFs are, and why they matter in the investment landscape. Mutual funds are investment vehicles that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Managed by professional fund managers, mutual funds aim to achieve specific investment objectives, such as growth or income. Investors buy shares directly from the fund at the net asset value, which is calculated at the end of each trading day. This structure makes mutual funds a popular choice for those seeking diversification and professional management. Exchange-traded funds, or ETFs, are similar to mutual funds in that they also hold a basket of securities. However, ETFs are traded on stock exchanges just like individual stocks. This means you can buy and sell ETF shares throughout the trading day at market prices. ETFs often track an index, such as the S&P 500, and are known for their flexibility, transparency, and typically lower costs compared to mutual funds. You invest in a mutual fund, your money is combined with that of other investors. A fund manager then uses this pool to buy a variety of assets according to the fund's strategy. The value of your investment is determined by the fund's net asset value, which is updated once per day. You can only buy or sell shares at this price, making mutual funds less flexible in terms of trading compared to ETFs. ETFs are bought and sold on stock exchanges throughout the trading day just like regular stocks. Their prices fluctuate based on supply and demand as well as the value of the underlying assets. This allows investors to react quickly to market changes. Most ETFs are passively managed, tracking a specific index, which helps keep costs low and makes them attractive for cost-conscious investors. Key difference between mutual funds and ETFs is how they are managed. Most mutual funds are actively managed, meaning fund managers make decisions about which securities to buy and sell in an effort to outperform the market. In contrast, most ETFs are passively managed, simply tracking an index. This difference impacts both performance potential and costs. ETFs offer greater trading flexibility compared to mutual funds. Since ETFs are traded on exchanges, you can buy or sell them at any time during market hours. This is ideal for investors who want to react quickly to market movements. Mutual funds, on the other hand, can only be bought or sold at the end of the trading day, limiting your ability to respond to market changes in real time. Mutual funds often have minimum investment requirements, which can range from a few hundred to several $1,000s. This can be a barrier for new investors. ETFs, however, can be purchased in single shares, making them more accessible for those with limited capital. This difference makes ETFs a popular choice for beginners or those looking to invest smaller amounts. These are an important consideration when choosing between mutual funds and ETFs. Mutual funds typically have higher expense ratios due to active management and other costs. ETFs, especially those that track indexes, usually have lower fees. Over time, these cost differences can significantly impact your investment returns, so it's important to compare expense ratios before investing. ETFs are generally more tax efficient than mutual funds. This is because of the unique way ETFs are structured, allowing investors to avoid triggering capital gains taxes as frequently. Mutual funds, on the other hand, may distribute capital gains to investors each year, which can create a tax liability even if you haven't sold your shares. This makes ETFs attractive for those looking to minimize taxes. Liquidity refers to how easily you can buy or sell an investment. ETFs are highly liquid because they trade on exchanges, and you can usually buy or sell them quickly at market prices. Mutual funds are less liquid, as transactions are processed only once per day at the net asset value. This difference can be important if you need quick access to your money. ETFs are known for their transparency. Most ETFs disclose their holdings daily, so investors always know what assets they own. Mutual funds, however, typically disclose holdings only quarterly or monthly. This level of transparency can help investors make more informed decisions and understand exactly what they're investing in. There are many types of mutual funds, each with its own investment focus. Some invest in stocks, others in bonds, and some in a mix of both. There are also sector-specific funds, international funds, and funds targeting specific strategies like growth or income. This variety allows investors to choose funds that align with their financial goals and risk tolerance. ETFs also come in many varieties. Some track broad market indexes while others focus on specific sectors, commodities, or international markets. There are also actively managed ETFs, though they are less common. This flexibility allows investors to build diversified portfolios tailored to their needs, using ETFs as building blocks. Both mutual funds and ETFs can pay dividends to investors. Mutual funds usually distribute dividends periodically, and these can be reinvested or taken as cash. ETFs also pay dividends, often quarterly, and investors can choose to reinvest them. The process is similar, but ETFs may offer more flexibility in how and when you receive your dividends. Mutual funds often offer automatic dividend reinvestment plans, making it easy for investors to grow their holdings over time. ETFs also allow for dividend reinvestment, but the process may depend on your brokerage. Both options help investors take advantage of compounding returns, but mutual funds may make it slightly easier to set up automatic reinvestment. Expense ratios are a key factor in evaluating both mutual funds and ETFs. This ratio represents the annual cost of managing the fund, expressed as a percentage of assets. Mutual funds, especially actively managed ones, tend to have higher expense ratios. ETFs, particularly those tracking indexes, usually have lower ratios, which can save investors money over time. Some mutual funds charge load fees, which are sales commissions paid when you buy or sell shares. These fees can reduce your overall returns. ETFs generally do not have load fees, making them a more cost-effective choice for many investors. Always check for any additional fees before investing in a mutual fund. While ETFs don't have load fees, you may pay a commission or transaction fee when buying or selling ETF shares, depending on your brokerage. Mutual funds may also have transaction fees, but many are available without them. It's important to consider these costs, especially if you plan to trade frequently. Because ETFs trade like stocks, their prices can be affected by supply and demand in the market. This can sometimes lead to small price differences between the ETF's market price and the value of its underlying assets. Mutual funds priced at net asset value don't have this issue. However, for most investors, the impact is minimal. Both mutual funds and ETFs offer diversification by investing in a wide range of assets. This helps reduce risk compared to investing in individual stocks or bonds. Diversification is a key principle of investing, and both vehicles make it easy to achieve, regardless of your investment amount. Many mutual funds and ETFs provide access to international markets, allowing investors to diversify globally. This can help spread risk and take advantage of growth opportunities in different regions. Whether you prefer mutual funds or ETFs, you can find options that invest in countries around the world. Mutual funds often allow for automatic investment plans where a set amount is invested on a regular schedule. This makes it easy to build your portfolio over time. While some brokerages offer similar features for ETFs, it's more common and straightforward with mutual funds. Some mutual funds allow you to buy fractional shares, meaning you can invest any amount, not just whole shares. ETFs are typically bought in whole shares, though some brokerages now offer fractional ETF trading. This feature can make it easier to invest small amounts and fully utilize your money. When you want to sell your mutual fund shares, you place a redemption order with the fund company, and the transaction is processed at the next calculated net asset value. ETFs, on the other hand, are sold instantly on the exchange at the current market price. This difference affects how quickly you can access your money. ETFs benefit from continuous price discovery throughout the trading day, as their prices adjust in real time based on market activity. Mutual funds, however, are priced only once per day after the market closes. This means ETF investors have more up-to-date pricing information when making trades. Dollar cost averaging involves investing a fixed amount at regular intervals, regardless of market conditions. Mutual funds are well suited for this strategy, as many offer automatic investment plans. ETFs can also be used but may require more manual effort unless your brokerage supports automatic ETF purchases. Tax loss harvesting is a strategy where investors sell securities at a loss to offset capital gains taxes. ETFs are particularly useful for this, as they can be traded quickly and easily. Mutual funds can also be used, but the process may be less flexible due to end-of-day pricing and redemption rules. Tracking error measures how closely a fund's performance matches its benchmark index. ETFs, especially passive ones, are designed to closely track their indexes, resulting in low tracking error. Actively managed mutual funds may deviate more from their benchmarks, which can lead to higher tracking error. Portfolio turnover refers to how frequently assets within a fund are bought and sold. Actively managed mutual funds often have higher turnover, which can lead to higher trading costs and tax implications. ETFs, especially those tracking indexes, usually have lower turnover, resulting in lower costs and greater tax efficiency. Mutual funds are often purchased directly from fund companies or through financial advisors. ETFs, on the other hand, are bought and sold on stock exchanges through brokerage accounts. This difference affects how you access and manage your investments, with ETFs offering more flexibility for self-directed investors. Mutual funds and ETFs are regulated differently. Mutual funds are governed by specific rules regarding pricing, redemption, and disclosure. ETFs must meet additional requirements to ensure liquidity and transparency, especially since they trade on exchanges. Understanding these regulatory differences can help you choose the right investment for your needs. Both mutual funds and ETFs can be held in retirement accounts like IRAs and 401(k)s. However, mutual funds are more commonly offered in employer-sponsored plans. ETFs are increasingly available but may require a brokerage account. Consider your retirement goals and account options when choosing between the two. Rebalancing involves adjusting your portfolio to maintain your desired asset allocation. Both mutual funds and ETFs can be used for rebalancing, but ETFs may offer more flexibility due to real-time trading. Mutual funds can also be rebalanced, often with automatic features, but only at end-of-day prices. During periods of market volatility, ETFs can experience rapid price changes as they are traded throughout the day. Mutual funds, priced once daily, may shield investors from intraday swings but can also delay reactions to market events. Understanding how each vehicle responds to volatility can help you manage risk. ETFs can be sold short or bought on margin, allowing for advanced trading strategies. Mutual funds do not offer these features. This makes ETFs more suitable for sophisticated investors who want to use leverage or hedge their portfolios. One of the main advantages of ETFs is intraday pricing. Investors can see the current price and execute trades instantly during market hours. Mutual funds, however, are only priced once at the end of the day, so you won't know your exact purchase or sale price until after the market closes. Both mutual funds and ETFs can play important roles in asset allocation. They offer exposure to different asset classes such as stocks, bonds, and commodities. By combining both types, investors can build diversified portfolios that match their risk tolerance and investment goals. ETFs are accessible to anyone with a brokerage account and can be traded like stocks. Mutual funds may require opening an account with a specific fund company or financial advisor. This difference can influence how easily you can start investing and manage your portfolio. ETFs have grown rapidly in popularity over the past decade thanks to their low costs and flexibility. Mutual funds remain a staple for many investors, especially in retirement accounts. Both options continue to evolve, offering new features and strategies to meet investor needs. All investments carry risks, and mutual funds and ETFs are no exception. Market risk, management risk, and liquidity risk are important factors to consider. Understanding these risks and how they apply to each investment type can help you make more informed decisions and protect your portfolio. Choosing between mutual funds and ETFs depends on your investment goals, trading preferences, and cost sensitivity. Consider factors like fees, trading flexibility, tax efficiency, and minimum investment requirements. Both vehicles have strengths and weaknesses, so it's important to align your choice with your personal financial situation. Many investors use both mutual funds and ETFs in their portfolios to take advantage of the unique benefits each offers. For example, you might use mutual funds for automatic investing and ETFs for low-cost, flexible trading. Combining both can help you build a more robust and diversified investment strategy. Recent years have seen a surge in new ETF offerings, including thematic and actively managed ETFs. Mutual funds are also evolving, with more options for lower fees and passive management. Staying informed about these trends can help you take advantage of new opportunities in the investment world. Summary: both mutual funds and ETFs offer valuable tools for building a diversified investment portfolio. By understanding the key differences, such as trading flexibility, fees, tax efficiency, and management style, you can choose the option that best fits your needs. Remember, the right choice depends on your personal goals, risk tolerance, and investment preferences. Thanks for watching, and happy investing.